Are you not buying the happy talk out of China in the last week?
I think in the short term, all these measures could work, given how negative the positioning has been in the sentiment. But I think the issue with China is much bigger. It's structural, demographics, the property market, consumer sentiment, a host of things, domestic consumption, right? Which is you can't export your way out forever, which is what they're trying even now. So I think that is the question. So I think in the short term, it's tough because the questions of what, is it a gun or is it a bazooka or whatever, right? So you fine, you bring your bazooka and that. But structurally, over the longer term, what changes?
How would you describe the move over the last week? Is that just shorts coming off, new longs going on, a positioning squeeze that turns into a bit of a mount up in the short term? What would you call this?
I would say it's a combination. It's a big relief as well, because so far the concern has been that in the past, they've thrown in a huge amount of stimulus. They weren't doing it this time. And so the concern was that they don't care as much. But now the opinion is that they do care. And now they're saying that this is very important and they're going to do something about it, right? So I think it's a combination of all those. And perhaps it has some staying power. But I take a step back and say, just like the US economy, the reason you're optimistic is structurally there are a lot of things different in the US. It's not the same in China. So when you put all those facts together, I think it's a wait and see.
So you said that there are some structural things in the US that are good. So you're bullish on the US?
Yes, I'm still bullish on the US, though I'm a little concerned at the pace at which we are going ahead. I think it looks too fast, too soon. But structurally, for example, the US remains at the forefront of the technology front, unparalleled. We are still one of the world's biggest economy, right? We are the world's biggest oil producer now. And we still are at the center, or probably the leader of the global financial architecture. And the dollar still remains a reserve currency, unlikely to change. So I think when you start putting all that together, mainly I would say even tech, because the secular shift in the markets right now is around technology. And the shift in technology, if you take a step back, is not something which is new. It's been going on for about 3 to 4 decades now, from the PC cycle to the internet to mobile devices. We were in the middle of a cloud transition, and then you got AI on top of that. And at the center of it is the action is coming from the US. And the ecosystem we have in the US, mainly around the Valley, is unparalleled and cannot be replicated just by infusing capital.
That's a great story. Yeah. You expect losses by the year end. How much short term do you expect this story to have been overplayed and basically everything to really face a whole lot of volatility based on potential growth headwinds, potential regulation, potential geopolitics, the election?
Absolutely. You raise a lot of right points. And that's why, if you see, my base case price target is 5,600. We're already above that. But we do have an upside case of 6,100. And in all fairness, a downside case of close to 5,000. So I think the way to think about it is big tech has corrected reasonably healthily. Multiples which had gone to about 34 times are now back to about 29 times. So just about the threshold where we feel comfortable. I think anything in the mid-20s to 29 in the range is reasonable because their growth is decelerating. So they are comping the comp. In other words, now they are looking at 60% plus growth rate to sort of match against in the coming quarters. And the expectation is that their growth will decelerate to around the 20% range. So pretty healthy. You're paying a PEG ratio of 1.3, 1.4, which is quite full, but it's not broken. But for the rest of S&P, the comps get easier. So you had bad numbers. Now the street's expectation is it goes up 15, 16%. I'm skeptical. I think it's going to be less than that. But still, directionally, what's happened is the composition of growth has changed. So big tech still leading, but moderating, reasonably priced. And the rest of the S&P, quite fully valued, I would argue, but growing at, expected to grow, in my view, maybe around 10-ish%, which is not a bad combination. It leaves me to your question that what about the levels right now? I think we probably need to take a little bit of a breather. And I don't know what the catalyst is going to be. Maybe it's elections. Maybe it's some geopolitical event. But we haven't cared about geopolitics forever. So I'm not too sure why we'll start caring now.
you have such a big gap when it comes to the upside and the downside.
Yeah.
And you say, yeah, you don't know the catalyst for what could be. Is
Sure.
there a potential of what the catalyst, though, would be to the upside if you're unclear about what it would be in terms of taking a breather?
Sure. I think the catalysts are very clear. You talked about the jobs numbers just now. So the big shift in sentiment over the last, call it, month or 2 months has been this growth scare, right? And so based on historical experiences, the market is very concerned, and we are, that is the labor market as robust as it seems? You know, is it a fact that labor market can decelerate very quickly? We don't know. We don't think so. But the point is, it is very clear that the odds of even a shallow recession have increased over the last 2 months. They haven't decreased, right? So that is your case, downside case. If you start suddenly seeing a deterioration in the labor market, which nobody is expecting, including us, but it is a real possibility because the odds have increased, you could start testing the downside. On the other hand, we are still printing very robust numbers. You saw the Atlanta GDP number. It came even stronger. Consumer sentiment marginally increasing. So I think if growth does accelerate, and there's a reasonable likelihood, even though that's come down a little bit, there you have my upside case of 6,100. So I think, you know, it all depends. And the derivatives market is telling you that the one thing they care about is the NFPs, right? So, you know, that's where the action is.
So good news is good news still. That doesn't change.
Yes. Right now, the good news is good news. We've shifted from that paradox of flipping it back. But I think the question is good news till something breaks, right? And so the disconnect right now is between the rates market and the equity market, right? And what I would suggest is that the rates market has been all over the map for the last 2 years. We're expecting 7 cuts, then 0, now, you know, 9 cuts for the end of middle of next year. So the equity market has been more right than wrong, right? And so that's an interesting situation we are in, right?
You throwing some shade at your colleagues on the other side of the room, that the bond market's been all over the place. Did you hear that? I heard that.
I heard that. So, you know, basically, is that your accusation?
Well, my point is that everybody looks at the rates market as a big barometer of what to expect.
Smart money in
right?
the room, yeah.
So, which is true, but my point is if you tried to follow that, you'd have gone crazy because you wouldn't know what to do a week from week, right?
Okay.
It's flipping.
All right, hold on a second. In fairness, so not to defend the bond market, but to defend the bond market, equities have had, S&P 500 has had 5 straight months of gains if we close out the month of September with a gain. It has come in tandem with 2-year yields having 5 straight months of yields going down. You're saying that that isn't directly correlated?
Well, what you really care about for equities is the 10-year rates, right? And if you look at 10-year rates, where are they moving around? Well, that is a discount factor because we're a long duration asset, right? And we were hovering around 5% a few months ago, right? And then we went to 3.5%. Now you're again going back towards the 4% range. So I'm not trying to sort of reduce the importance of the rate market. It is very, very important because it is a discount rate that factors in.
He's trying to bring back his bond market colleagues. Carry on. Come on, keep going.
But at the end of the day, you know, it's been all over the map. And let me tell you something.
Please do.
So everybody in the macro market is concerned about deficits, right? So you would expect that shows up in the term premium. Where is it?